Welcome to the Blue Sky Business Acquisition Podcast, Episode 3, Buying Smart. And today we have our co-host, Judd Goodrich with Main Shares. Our sponsor for today is Squash CPA. Smart deals start with solid numbers. Squash CPA offers next-generation quality of earnings and due diligence to help you navigate your deal confidently. Get started at squashcpa.com. Dave, thank you so much for your sponsorship and your continued high quality of earnings. Definitely helps buyers navigate this process. And with that, I'd like to do a quick introduction of our main hosts. My name is Matthew Brazel, Finance Director for Sunbelt Business Advisors of Wisconsin. I help buyers find the loans to buy the business.
Tom Flanagan. I'm a broker at Sunbelt, Wisconsin as well. Excited to be here. Excited for our guest today.
I'm Ben Woodward. I'm an SBA lender focused on financing acquisition transactions.
Awesome. And without a doubt, I would like to introduce Judd Goodrich with Main Share. Judd, if you could, for our listeners out there, kind of take us through who you are, what Main Shares is, and how you help the buyer community acquire their business of choice.
Yeah, of course. Thank you for having me on. So yeah, my name is Judd Goodrich. I'm the head of capital markets at a company called Main Shares. What I am responsible for is all the deals that we ultimately help support through raising capital to actually closing, and then I also overlay in kind of an investor relations function to help attract new capital into the space to help capitalize these transactions. Our fundamental goal is to enable this wealth transfer that everyone talks about, the silver tsunami, but while keeping these businesses locally owned and individually operated if possible. You know, if we can look back in 10 years from now and, majority of these businesses aren't owned by large PE buyout funds, that's a huge win. What we do and what we're focusing on is effectively a kind of providing the community, the capital, the tooling that's necessary for this next generation of business owners in order to identify, purchase, and successfully operate. Core to the platform that we built out is a way to actually raise equity capital on a deal-by-deal basis in order to transact and buy the business that you're ultimately looking for. Right. So we're working with helping like true operators in the space that have a lot of industry experience identify, source, and buy businesses. We're helping key employees at some of these businesses. This could be like a GM, president, CFO, move through and take over the reins. And then obviously, first-time operators and buyers. Have completed about over like 60 transactions over the last 5 years, raised tens of millions of dollars in this capacity. We're mostly focused on B2B services, home services, niche manufacturing, healthcare deals. Really, where like strong cash flow is predictable, so less of the distressed startup game, and kind of in the realm of maybe $500,000 to $5 million of EBITDA, and all in the United States. So excited to chat and kind of tell you what we're seeing on the ground here. Thanks for having me.
Awesome. Yeah, very excited to have you and learn more about you guys too. I know met Will a couple times, and it seems like you guys have a great business model, and just as far as what you're looking to do. And we've sent over a couple buyers your way, and it seems like they've had a good experience. So excited to get into the weeds more as far as, how you identify buyers, how you look at, specific industries and businesses, and then, just the education side of it as well. I think there's a lot of folks that don't know you exist, right? And this is, partly why we have this podcast, is just to help more people get deals done and understand the process more. And your service is really needed, and I think really, really interesting. And so, yeah, as far as that goes, I know you guys look at a number of different industries. How do you identify and sort of select those specifically? I mean, is there a certain method? I mean, are you looking at just general economic conditions or forecasts, or is it operator specific?
Yeah,
I mean,
yeah, I think there's definitely a component of like there's specific categories or industries or subsectors that I think are more attractive um, to investors that we're currently working with. Right, this continuously expands, and as we're introducing kind of new parties that have different preferences, different backgrounds. I think in the end of the day, like a lot of people that want to invest into what they actually know and understand, right? So as we kind of scaled out and started working with more folks that were running digital marketing agencies, okay, they're really interested on like expanding their portfolio effectively. So I think the bigger component that we're looking for is the operator to business match versus, okay, we're only going to service these types of businesses, because in the end of the day, there's not a lot of people that are like investing into this space. So the percentage that have this really narrow buy box is relatively lightweight. You maybe see that on like more like committed funds will obviously have a thesis and they can only really invest into certain assets and strategies and things like that. But most people just want to participate in this like transfer, right? It's the private equity is the highest returning asset for decades. There's a reason behind that, and there's a reason KKI are buy like 1,000 dentistries and like these different things that you see happen time and time again. So our bigger thing is looking for individuals that have really solid specific types of backgrounds, or just are willing to like be very gritty to get this done, right? They understand how to manage teams, they understand how to create processes, they can talk the language of their customers, their suppliers, because there's a lot of folks that really don't have direct exact experience operating a landscaping company. It doesn't mean that they're not going to be successful, so we're looking for specific characteristics
mhm.
about the operators more so than the industries.
So Judd, like diving deeper into that, like how do you build that buyer profile, right? Because obviously you're finding this buyer, right? And then you're taking them to the investors and really selling it to the investors to get them to invest to be part of the equity stack, right? Or capital stack. So what goes into that? Like what's your kind of due diligence process as you go through that?
Yeah, so like in order for and to one caveat is we besides our affiliated broker dealer that's actually taking like a hands-on position raising the capital, um, we're actually not raising capital on behalf of the sponsors or the searcher issuer in this case, right? We are connecting capital that's interested in a specific category. So a lot of it is like the vetting work that we do, the positioning, framing of the investment opportunity, which we can help out with. But there's like three characteristics that we're generally looking for, and it goes into the management team, the actual deal, and then the structure and the setup. So like like all those three facets basically help us understand how attractive of an opportunity this is. And I'll go into them a little bit more depth, but we're basically we have over 1,000 investors. We've seen millions of commitments. We are able to get a better scope into what people actually care about, like what works, what doesn't, what structures, what types of deals, what types of operator backgrounds are more attractive than others. And that's basically given us the feedback loop to ultimately decide what we should focus on. Some of the like the characteristics on the management team, which I think is where we usually start, because if it's not the right jockey per se, the industry, the deal, all this stuff matters less in our opinion. So like we're doing basic like background credit checks. Want to make sure these are upstanding citizens. We're usually running different types of like interview style to understand you know, really do they understand this industry, this business? Where are they going to be able to provide value? And I think this is one of the big things that, last month I looked at 4 or 5 HVAC businesses, all super similar makeup. Um, Mostly new construction in up and coming cities. And I'm like, okay, like the only difference between all of these deals is you, right? Um, And I think it's like really pressing into like, what are they going to bring to the table that someone else potentially doesn't have, or what, supporting cast have they done? What is their edge in this scenario? It really comes
Mhm.
down to like, that's where we see like a huge gap, to be honest, where some people have really thought this out. They understand the transition plans. They've built out and structured a deal that has um, different seller financing notes. They have comp plan adjustments for key employees. They've identified the suppliers and customers that they need to ensure that they retain on. They've done a lot of these things to like ensure the transition, and then they've identified the risks and the growth strategies up front. And I think those are where things get relatively in the weeds. But that tells me a lot about who the management team is and if they're going to be successful. Which then the rest kind of comes in line, and we kind of make our way down to the deal, looking at the historical financials, the operational side, the um, org chart, the actual owner, what are they responsible for? Where's the key man risk, to the final, to the structure, right? Where I'd say this is where people miss quite frequently is um, taking on too much debt, having unrealistic investor terms that are going to get balked at, things along those lines. So,
Well,
yeah,
when you
anything buyer, yeah.
yeah, and the further add on, when you guys really find the deal that you want to take to market, right? You guys have really spent some time working with that buyer on helping them with that letter of intent, right? And then connecting them with the quality of earnings partner, right? And the advisory services, right? Which is like, as I'm looking at different deals about, hey, what's a really well put together deal? What's a really good package that I'm looking at from a lending standpoint, right? Those are the kind of things that I kind of focus on when I'm picking up a file. And you guys tend to put a really good file together that it's pretty easy to go through the deal. So why don't we kind of go into more depth onto that, right? Because that's a really high, I think, a big piece of value that you guys add from a market from a standpoint, right? So let's cover that.
Yeah, I mean, you're spot on. It's one of the things I noticed with a lot of the deals that would fall apart was like weak supporting cast in any of the capacities, right? It's like if you have someone that isn't as like fluid and or maybe structured on the quality of earnings process, and now you're just like fatiguing the seller, right, over a long period of time, or you're getting way too aggressive on the purchase agreement and not knowing what to actually fight over and what you should let go, right? And that's, you see that on the attorney end. Same on the you know um, on the debt side or the equity side. So like we actually were able to like learn this process in its entirety as a result of like the original business that we launched was Beacon. Where we transacted like probably 50 small businesses. We had a deal team that handled all these transactions. We saw it from the seller's perspective. We handled and we helped out the buy side. And I think we realized that if we can bring in the right parties to these deals, the whole process is a lot more seamless. And if you have these, kind of side characters that are derailing things, or you have the wrong point person on this that's orchestrating the entire deal, then it's really hard to actually um, come to a conclusion and come to an agreement on both sides. So yeah, I'd say it's something that we have leaned into heavy, is kind of helping be that project manager across the whole transaction.
Judd, just kind of thought popped into my head, but you guys deal in a lot of buyer side, right? Buy side stuff. How many of your buyers are self-sourcing their business to buy versus how many of them are using a listing broker?
Um, I would say the percentage of people that are getting deals done without a broker is pretty minimal. A lot of people, is that what you're referring to, like proprietary
Yeah.
outreach and yeah, off market deals? It's not very common. Like people love it. They love the idea of it. They all have a like proprietary outreach sequence and mechanism. Um, we also saw that like as a business, um, broker and representing the sell side. Like we had an entire engine, we had multiple, like a team that was building this out for years. And I would say it's quite challenging. So like you basically have to source the deal. You somehow have to act as the unbiased intermediary to help value this transaction for the first time potentially, and you maybe never bought a business. Um, where you are on the other side of it, but you're like, this is the price, right? That's where like a broker is super helpful because they're helping set expectations and kind of move through, here's the information that's needed. So like the percentage of people that are actually doing those type of deals, I think is quite low. Where I do see it is after, and this is where people find really interesting opportunities, is get in the game, right? First acquisition, now you're a business owner, you start to meet other, players in the space, you start to meet other suppliers in the space. The first place that most sellers go to is the other business owners that they know in the region is the most common, right? That's where people are actually getting most off market deals, in my opinion. So
Mhm.
people, if you have a long
That's a
time and
good
you have
point.
years,
That's a
like
great point.
you're for it, but otherwise for your first acquisition, low percentage are off market.
Now, a lot of people, because a lot of people want to get in the game, they want to find that business, and they have that excitement and that grit. You said earlier, there's a combination of things that makes a good operator or buyer on your side, and I'm sure it's hard to pinpoint one, two, three things specifically, so it's kind of a whole package. Um, but at the same time, right, you guys are looking for investors to kind of help back that buyer. So um, they may not have that back end financial capability, um, which I think for maybe you, Ben, that can be a concern, right? If it, otherwise, if they weren't working with you guys. So how do between maybe Ben, this is a question for you, but Judd, jump in too. But how do you look at that? Hey, the buyer isn't really, doesn't have much capital here, but they're talking to the main shares. They seem to like them. They have a good track record. You know, how's that dynamic on the bank side work?
Yeah, so look, when I look at a deal, right, the things that I look at is um, who is the buyer? Like, what is their experience? Is it direct experience, indirect experience? Does it translate into them stepping into this company? So that's what I look at first, right? Is do they have the capacity? Do they have the team in place if they don't have the capacity necessarily, or are they adding a key employee from that existing company to come on board, right? So that's the first test, right? Then as I dive into their financial background, like what type of means do they have to buy this company? Do they have any of their own capital? Are we doing 100% equity raise? Like, what does that mean if 100% of the equity is coming from investors, right? What is the real skin in the game that the buyer has in that deal, right? So the PFS is important, personal financial statement. So I also look at, okay, if this buyer's in this deal, like what other sources of repayment do they have? Do they have outside income? Do they have um, connections to additional funds that they could raise if need be? Should they get into the business and we have a bit of a J curve on it, right? And the numbers don't come in. So I look at that. I look at the resources. Who are they connected to? Um, and then it's, do they understand the company? What are the conversations that are going on with the seller? Are we getting reliable information? What's the quality of the financial statements? What type of accounting do they use when looking at the seller side, right? How do they track their invoices, right? How do their customers pay them? How do they work with their vendors? Who are those vendors? Are there any concentrations, right? So I'm looking at all these things as I'm looking at a deal, right?
Mm-hmm.
And then I also too go to how is the letter of intent written? What things are covered in that letter of intent? Who's the counsel that's representing the buyer? Who's the sell side counsel, right? Is there quality of earnings? Who's the is the insurance team in place? Are the advisors in place, right? Um, thinking of some other things too. How did they come to, why is the seller leaving? You know, uh, what is that relationship with the seller? Have they been able to talk to the employees at all? That can be a tricky one because you don't want to, like when the seller's selling, they don't necessarily want it known that their company's for sale. And then how did they come to that sale price, right? Matt, you brought this up earlier about multiples, and here's how I kind of look at it. Can the buyer pay themselves with the leverage that they're putting on the deal? And is that leverage have any wiggle room on it, right? Because what if the company doesn't exactly perform like they're saying it's going to perform, and then all of a sudden that buyer has to look at it from a standpoint of, do I have the ability to pay myself and pay this loan, right? Do they have the character to say, I may have to go out without a paycheck for a period of time, right, as I'm running this company? So I kind of covered a lot there, but I'm going to give it back to you guys.
Yeah, Ben, I wanted to add something. The skin in the game, I think, is like, I think people think about us and like, they're like, oh, I can just come to main shares, raise all the money, put no equity
Right.
in, you know, and it's like, couldn't be farther from the truth. The reality is like, no one wants to back someone that has not thought about this, isn't all in, right? In the end of the day, like
Mhm.
the equity gets wiped, right? So if someone's like, I can put in $10,000. I want to get mostly seller finance, no recourse on it, right? And you're asking for $100,000 per check, right? 10x the amount that you're willing to put in, you could just walk, and you lose $10,000. We don't even see that your personal financial statements say you could probably have put in significantly more. So we're looking for like the same things where it's like, it's really hard to convince. It's basically like a bunch of credit committees, like a bunch of individual investors that have to get over this. And I would say it's like a huge component to us where this number varies depending on who the person is, but like it's definitely the all in mentality that we have to find, because at the end of the day, like, yes, if you overpay by 15%, if you don't account for working capital, if you don't account for like all the capex maintenance, like things can get rough. But like there are certain
Mhm.
characteristics of people that will ride it out, and there's certain people that will quit, sell the business for a loss, the equity gets wiped. So that's relatively common. It's even like we were working on a heavy seller finance deal recently, and I was like, okay, based off of how much you're putting in and how much you still need to raise, which is about $1 million, I was like, you're gonna have to like personally guarantee this seller finance note if you want to raise this money. Is my guess what the market's gonna say, and they didn't understand it. Then started talking to
Mm.
investors. They're like, wait, like you have no downside in this scenario. Like
Right.
you could leave and you can be done, and I will lose hundreds of thousands of dollars. So we look at it super similar from the lending side, and I think that's why we work pretty well with some of these different like banking partners. So I think you're spot on, Ben. It's a lot of people think that zero cash down, we're going to do the an equity roll, and the different SBA things that have happened over the years, and then you ask lenders and they're like, not many deals get done that way. So
Well, to that point, I think with all the updated SBA rules, I mean, it's very attractive to be able to come in and buy a business with very little cash down. But an SBA loan still requires personal guarantee. And the issue then becomes, if you're not putting skin in the game, how successful are you going to be? And I mean, I, for one, work with a lot of banks, and not very many of them are allowing a buyer to come in with no cash down. Almost every single one of them wants at least 2.5%, 5%, sometimes even 10% on top of the seller note coming in, just to shore up that loan amount, that debt service coverage. So
Yeah, I mean, especially if you're a first time buyer, right? Without the experience or the management experience, operational experience. I mean, there's so many factors that go into it. So, on all sides. Um, but with that, Judd, it seems like there's got to be operators just banging at the door for you guys, trying to, trying to work with you. I mean, do you mostly look for a signed LOI first before you're interviewing folks, or is it, how does that work? I apologize if you meant reviewed that already, but
Yeah, yeah. So like we do have like a full operator network and kind of like a buy side advisory, buy with main shares arm, where we do work with folks throughout their search cycle. And that can be obviously well in advance of an LOI as they're going through this process. But generally, if someone is looking to raise capital that hasn't gone through kind of our programming, yeah, the deal is going to be under contract. A lot of times, individual diligence, quality of earnings is underway. There's a direction on where the debt is going to come from, and we have a kind of a full picture. That's usually at the point in time like that my team is getting involved, and then occasionally we're making introductions to different you know debt lenders or whoever that might be. But yeah, we like to see like here's the capital stack, here's the strategy. Like, we got to see like a deck, business plan, risks, growth strategies. Love to see how they're modeling this out as well. um, so those are usually like kind of some of the components we're looking for.
You,
But people have
Judd,
to
you touched on something, and I want to just kind of ask this. I mean, you get to see a ton of business plans, right? Um, I mean, when we think about the complexity of what goes into them, how many of them are actually quality plans versus ones that are just slapped together with very little thought?
is a good question. So like you can find out with like level 2 or level 3 questions on almost anything if it's okay, for example, it's like we have the ability, and I was looking at a deck recently, it was like the the owner is currently undercharging for the services that are being provided. This is like a marketing agency. And I was like, oh, interesting. Okay, like you say that you can charge 20% more. Like how do we get to 20%? And it's like, oh, it's like market data. Oh, could you show said market data? Well, it's actually like the seller, and then all of a sudden, like the conversation jams up. And I was like, go figure out if this is actually the case, right? Because you now look like you were lying, or you don't know. Either way, it's bad. So it's like not uncommon for people to slap on like pretty lightweight, okay, we're going to add an ERP system, and then they have no idea how to like what even step 1, 2, and 3 is. Even like an ERP integration, like who are you going to go to? How much is this going to cost you? You haven't modeled any of this out. You want to grow at 20% year over year. What is that from a CapEx perspective? How much are you going to have to do to maintain these trucks? Like your costs and everything are going to directionally be impacted by this. So I think
Mm-hmm.
there's usually around like the growth strategy that I'd say are underappreciated. Realistically, like I think it's the best people are they're buying businesses that are relatively stable, and they're hyper focused on keeping the status quo with a couple bets that they could increase once they stabilize the transition. Right? That's like, in my opinion, key and really overlooked, where people are like, okay, in the first 3 months, we're going to completely retrofit this business, and we're just going to start pumping Google spend ads. And it's like you don't even really know who your ICP is, like where where you were getting customers before. Oh, and lo and behold, you don't have the foundation laid out. That was just the owner that was just saving the day at all times, and every challenge they knew the answer to. So I think it's like those are the people I think are really good, are the ones that are like hyper focused on the 30, 60, 90 day. We actually noticed that was like where people would really struggle, and they kind of set them up for a poor first year, and generally kind of like compression in the first year, even occasionally. So we started actually supporting some of like the transition planning stuff for the first 90 days, which has been cool to see, and it's seemingly helpful for these folks.
Judd, I think you hit right on the nail on the head, right? Like oftentimes, like so in projections, right, you do a monthly projection, but the thing that sometimes I see that doesn't get thought out right is like the sales cycle, right? Like and so at the early stage you're flush with cash, right? And so you're just like, oh, I can do this big marketing spend, right? And then it gets to December and you're like, oh, I didn't think about, hey, the slump in sales in my slow season here, and my need for cash, right? I spent that on Facebook, right? And now I need to have working capital. And so, it's really understanding, like, uh, there's another organization I'm involved in, uh, called the Turnaround Management Association. They focus on 13-week cash flow modeling, right? To give them like a week to week cash flow modeling. And I just think that, like, if buyers would maybe focus on like the initial, like you said, first 90 to 120 days of what that cash flow is really going to look like, right? uh, they would be able to kind of anticipate, like at the end, what those potential cash flow shortfalls are going to be.
Yeah, you're spot on. It's like if you can understand or maybe like decrease your like cash conversion cycle or know what it's going to happen on your fluctuating months, you can be definitely in a position where it's like um, more direct with like some of like your outlays of cash versus. And I had a friend that I had multiple friends that have bought in businesses, some that have scaled up small businesses, and like they've all fallen victim to this at one. They're like ready to scale, and then all of a sudden, they're like, I don't have my accounts receivables figured out yet, and like people aren't paying as fast as I would assume they were, and now I have payroll and like whatever it might be. So you're spot on.
Now, Judd, do you guys at Mainshares, do you have, resources or support, whether that's 90 days, after acquisition? What does that look like on your guys' side?
Yeah, there's a couple different strategies we have, and this is what I get pressed with a lot from investors is like you can vet deals, you can underwrite people. And the end of the day, like post transaction is where you're going to have great outcomes, mediocre, and bad outcomes. So like the way that we think about it is one is can we stack the cap table, right? We're not going for like doctors, lawyers. We're going for successful business owners, investing professionals that have been in the space, been able to figure out how to create value within their portfolio companies. Um, we're looking for people that have specific backgrounds. So a lot of like people that are coming from like tech companies that have figured out how to do SEO really well and they're on the marketing side. So it's like start there where you have people that are actually like really aligned. Then what we've started to do is like introduce different type of advisors into these deals as well, where hey, I need one specific, like we help them identify if there's a specific gap into what they need in order to execute. Let's go find someone that's really good at that. They don't need to be an investor. They can have a small percent of ownership, and then they can work ad hoc. So then the idea is post transaction, yes, we'll help with like transition plans, but in order to have really true value, we're going out and we're pulling in um, really strong operators, business owners, specific type of like um, stakeholders in these like deals that can help out post transaction, and then attach them
Mhm.
to the deal because we don't make money. Our business doesn't work unless these businesses are successful. So like our goal is for
Yeah.
everyone that goes to our program is to stack the deck. Does that
So,
answer?
Yeah.
so
Makes
Matt
sense.
and Tom, I want to
Yep.
flip the question back over to you because you guys are representing the sell side a lot, but you get a lot of buyers that come to you. So when you guys are doing your buyer vetting processes, Matt, mainly you because you're the finance director, right? What kind of things are you looking for in that when that buyer comes to you and says, "Hey, I want to write this letter of intent on this business"?
Well, first thing I'm going to look at is a personal financial sheet, right? I want to make sure that there's liquidity there, not because, you know, they have an imputed equity position that they're going to have to come up with, but I want to make sure that if we get 30 days, 60 days, 90 days down the road, there's not a cash need, right? So basically, if I'm looking at someone who wants to buy $1 million business, I want to see 160, $170,000 cash in the bank, knowing that they're going to need to commit 5 to 10% of that, right? And then second thing I'm looking at is general experience. Do you have direct industry experience or do you have linkable experience, right? If you got a lot of experience and you've been a team lead and you've been directly responsible for 20 people, awesome. Let's go. That operational experience is huge. But if you're looking at buying a plumbing company, and you've never turned a wrench before, that might be problematic, you know? And but I think the biggest thing for like us is when we're bringing deals to market, and like Tom and I sold 14 transactions last year, ranging from $100,000 in sale price all the way up to 3.8 million. And I think the biggest thing is a lot of the buyers that are looking at this are, I call them accidental buyers. They're people that just kind of one day saw a business that maybe kind of sort of was interested to them and they went down that path. And then they slowly but surely put together the plan structure to buy the business. Very few people are, the searcher model where they've been looking for 6 months. And, searchers obviously are very qualified to buy businesses. They've gone through the planning process, the vetting process. But I think the biggest thing is, I look for commitment. How's that sound? I want to find
Yeah.
someone that finds a business a passion.
There's
If you're not passionate about it, it's tough.
I like what Judd said, the level 2, level 3 questions, right? When you kind of drill down into it and there aren't answers, that's okay. But there needs to be an effort to provide answers to that, instead of sort of just fading into the into the distance, or not providing it, or just saying I'll figure it out. Because we like to say it's like climbing a mountain every day, like you have to kind of like look at the forecast. You gotta have to like, you know, pack your snacks, right? Or food with you. I mean, you gotta have to have money to be able to, get to the finish line. Um, you have to know the route you're going, right? You have to pick a route. A lot of people are inquiring on all sorts of different businesses, right? We had somebody recently that asked for an NDA on 20 of our listings. It's like, are you serious at that point? If you're that spread out, from $200,000 listing to a 4 million, so there's a lot of signs, right? As far as knowing that someone is serious or not. And then once you kind of know they're serious, then you get to the level 2, level 3 questions. Uh, and, maybe there's not answers, but that's where, we introduce them to you, Ben, or maybe Judd. We get them over to Main Shares. We get advisors in front of them. And if they're willing to pick up the phone and talk to people and put a team together and take the advice, I think that's where success comes from. So
I think in a lot of cases with new buyers, the phrase "you don't know what you don't know" goes a long way, because there are a lot of moving parts to buying a business. It is a complex transaction. Diligence can be, very complex. So I think having the right partners in your life is one key component to buying smart. Partnering with the right lawyer, the right CPA. If the deal's large enough, doing that quality of earnings, I think is absolutely critical and crucial. And to cycle back to the business plan, uh, guys, for buyers out there that are listening to this, if you can't write a business plan, that's fine, right? There are services out there that'll write your business plan for you. They'll ask you those level 2, level 3 questions, and they'll put you into a position of success, right? Um, but I think, as a listing broker and a finance director, I want to see a buyer that's willing to commit. I think commitment is one of the key components. If you're dipping your toe in the pond, are you really serious? And then when we get you over to Judd, and those investors are stepping in, I mean, these guys are willing to strike $50,000 to $100,000 checks on your behalf. If you're not ready to dive headfirst into the pool, as it would be, that's probably problematic.
Yeah.
yeah,
One of the characteristics that's interesting is you I think a lot of these buyers, they feel like they have to have all the answers, right? Um, so they put on this face like I know everything. The ones that are
right.
really good are able to do that, but they're also able to go back and be like, okay, I don't actually know what I need to do next, to someone that actually knows what's going on, and seek direction.
Mhm.
So I actually Um, I'm like working with this nonprofit called Owners in Honor, and it's to help veterans buy businesses. And what I've noticed with a lot of veterans is they are really good at this aspect. Right? They know what they know, and they identify what they don't know, and then they seek advice, and they actually apply that advice. I think that's where people really miss here is they, as they're talking to brokers, as they're talking to sellers, as they're navigating like the purchase, as they're operating the business, they think that they need to know all these answers. The reality is, it's like you can do this for a very long time and still not have all the answers. And you don't need to have all the answers around, okay, what are the new SOPs for the SBA? How should I be putting together this LOI? There's plenty of people that can actually, that's all they do. So it's like seeking that direction and being, curious enough to be able to ask the questions. And I think that's where people win and other people generally lose. And then they're, running down this path with like no opportunity for success is like the reality. And I've seen it happen dozens and dozens of times. And that's where they're like 2 years in, burned a ridiculous amount of cash, a bunch of dead deal fees, and they think that the, the game is rigged. So kind of a
Right.
call out that I've noticed.
Well, so Ben, you're a high level SBA producer. I mean, you did almost little over $50 million in production last year, right? Um, but not every deal gets done. So from a buy perspective, what are some tips that you can offer up to our listeners to make sure that, the transaction goes from offering to acceptance, from acceptance to, counsel, from counsel to approval, from approval to underwriting, from underwriting to closing. I mean, there's so many variables in this that can go wrong. What are some, we'll call it nuggets, that you can share with our listeners as to how to avoid those pitfalls?
Yeah, I think one of the things is being an adaptable buyer, meaning that like when like I'm coming to you with questions, it's not to make it tougher for you. It's I've looked at my credit memo that I'm writing, and I feel there are gaps in my presentation, and so I'm trying to fill those gaps. And so sometimes what I find is like when you ask those second and third level questions, right, that you get some pushback in that, right, or they don't want to they're afraid to go to the seller. But the reality of it is if I'm asking the question, it's because I'm looking to answer something that I feel needs to be discussed in the credit presentation. I'm not doing it out of to make your life difficult. And so it's personality, right? Like, are you working with all the parties, right? Or do you get upset? Like, I think that's a big thing, right? Is like being available, and the communication style, I think, is one of the most critical things. I think the other thing too is is when I'm looking at a deal, I'm looking at those things I highlighted earlier. What things are like, is the letter of intent just like basically this is the purchase price, right? No allocation, no understanding of working capital, no non-compete, all that stuff. But you see it like the business plan's one page. The projections show that they just basically straight lined them across the board, right? With no written analysis to tell you like what's going on post
Or
acquisition.
or they have a 50% increase in revenue their first year
Yeah.
with those supporting comments.
Yeah. And like one of the other things I see, like you're looking at financials of the deal that they're buying, and you got uh, 21, 22, 23, and 24, and this rapid spike in 24, but the other 3 years weren't even close to that. And there's no explanation for that. Like it's like if 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 I'm like really looking at a deal and I'm potentially buying a company off of 24 numbers, I better have a pretty good understanding of what I'm doing and like the ability of that business model to continue on a go forward basis. Uh, if I so that I don't buy off of 24 and then all of a sudden the numbers tank right after I buy it because uh, that they cut costs or something like that, right? So I think those are all things like they really have to pay attention to. And when you start to ask those second and third level questions, you really start to understand how far is the buyer into this deal.
Ben, I had a question for you on that. So something I noticed was even like 2, 3 years ago, I was looking at like kind of like an archive of a bunch of like investor facing decks, and pretty much everyone used a 3 year weighted average EBITDA on all their pro formas. Now I only see TTM, right? Which is obviously quite the compression. And maybe that could work if there's minimal variability, but like a lot of these businesses do have quite a bit of variability. And one of the things that has been coming up quite a bit is you have COVID years, right? And like my first thought is like people are like, well, it's just COVID, and they're kind of writing it off, or it was just this one circumstance. You know, the owner went through and like was going through chemo, and like they pulled out of the business. Whatever the story is, what I've been requesting and for kind of pressing on is like, show me the 3 years before. Like the average deal we're working on is like 10 to 30 years. And then when I see 5, 10 years of historicals, that's not even true half the time. And I guess like I don't know if you're
Yeah.
noticing that, like how you verify these scenarios that are like, you know, unless you were there, it's really hard to determine if it's actually true. So that was one of the ways that we've been like trying to see if that's accurate or not. And then it's, sometimes it is. And it's like, actually, this business would have been super solid. Then COVID, then they explained exactly what happened during COVID. And then it's now recorrecting. But I'm curious with these like large events that have fluctuations, like how do you get comfortable with that?
Yeah, so I mean, there's obviously, I think on situations like that, a quality of earnings is something that's a component that could be brought in, right, to do the verification, right, for the buy side, right? But you're right, going back to prior years, getting 5 years of tax returns, 5 years of P&L, right? Um, Looking at do the P&Ls foot to the tax, right? Do If they don't, what are the adjustments, right? And then if you've got an anomaly year, you know, do you throw that year out and then take the 2 years before and the 2 years after, right? To to get to what the real value of the company is, right? Um, so there's a lot of things to look at, and that's really where I think that quality of earnings person helps that buyer, right? Because like they're going into that, but yes, you can go back to the prior years and look at that company. The only thing is there's been pretty significant inflation in the economy since we were back in the 17, 18, 19 years, right? That have really changed where revenue is. Now, if you're looking at just purely margin percentages, right? Uh, that's might be where you get your data. There was a credit training class that I went through early in my days at a different lending institution that I worked at, and basically that guy said, lay out the financials side by side, right? And then look for the changes and build your questions around those aberrations,
Yeah.
right? And that'll give you the story. So I've that's been largely one thing that I've like out of the significant piece of training that I got that I took away, and like I do that a lot when I look at deals. I look at each year side by side, look for the percentage changes on each category, right? And then kind of build my questions based on that. So if like one year you have 200,000 in professional fees, but historically it's 20,000, what happened in that year?
I think that's great. Yeah. It's a good call out.
So I think that answers your question, Judd.
Yeah, yeah. I mean, there's always a lot of different ways you could tackle it, but I do think um, people can kind of just bucket it in as just like a kind of a down year, and then it's like, okay, wait, why were your cogs so much higher, or like why do you think that you're going to be able to decrease them 5% on a very low margin business? It's like, yeah, that would be probably great, but there's got to be market pressures that make that very challenging to do. So
Well,
appreciate it.
I mean, it's a risky industry regardless, right? And that's where I think you just try to have as many people that can put their eyes on it and, give their 2 cents, because you could be a turkey too, right? I mean, you're getting fed all year round and feeling good, and then Thanksgiving comes around and
On the plate
now
you
you're
go.
now you're on the plate. So yeah, I mean, this has been an awesome discussion. I think there's so much
Well,
we could continue to kind of go into.
agreed. And to plug what next month's topic about is exactly what you just mentioned there, Judd, is, valuation. And, what is truly a realistic valuation for a company versus an excess valuation. And I think as a listing broker myself and, being a signed broker on 16 transactions, we try to, we as brokers try to make it make sense to, the buyer. There's got to be an ROI. If there isn't, then the question for the sell side is how much risk are you willing to take to transact this business? And in any transaction, there's a healthy mix, right? And it's all going to boil down to buyer experience, capital structure that's going to transact the business. And I think a lot of times it's, the seller commitment. Is the seller willing to stay on and train for 3 months, 6 months, 9 months, or, up to a year? And I'm a big fan of when you have an overly, as a buyer, right? If you have an overly complicated business with a lot of vendors, a lot of receivables, there's a lot of GLs that are associated with the business, of doing a 95-5 split purchase. And then having, buying that seller out is a second golden parachute in a few years, because it provides a level of commitment for you as a buyer, a safety net, where that person that's been around for 27, 30, 33 years is there in a limited capacity, but they're able to help soften the blow or soften the transition. And so I'm a huge fan of an equity play when coming in and buying a business, or especially over a seller's note. You're going to come in and offer 25% on a seller's note, you better have a full price offer or more, you know. But well, Judd, you guys have done such a great job in the market. You've helped a lot of people. You've definitely brought some, we'll call it differentiators to the market and how someone can buy a business, right? So let's argue and say that a buyer comes to you and they're going to do a $1 million capital raise. What does that mean for them in their business? How does it work? How does it structure? What is the end result for the buyer that would be using a main share service?
Yeah. So if they're raising $1 million, the way that this does vary depending on the biggest like variable of like how the economics work for an investor and what you're giving up effectively is generally a facet of how much debt leverage you're putting on the business. So just like real estate, um, debt leverage amplifies returns. Less leverage obviously lowers return profiles, maybe makes a business a little bit less risky, right? Once you get past this like SBA size deals, it gets closer to like 2 turns or 2.5 turns of EBITDA. Maybe it's 50-50 equity to debt. But let's take it for the standpoint of it's like an SBA deal. So we're the way that would usually get set up is investors are going to be looking for preferred participating equity, right? So what they want is they want to be above common on the capital stack, which means they get paid back before the operator is going to start taking advantage of the cash flow nature of the distributions. That's pretty critical considering they're putting in majority of the money. Um, the way it usually works out is they're going to get a preferred return. Right now, it's probably 10 to 12% of the invested capital. What that's usually set at is investors want that to be the highest coupon on the capital stack, right? If your SBA coupon is interest rate is above, like you should pay back that first. Obviously, they want to incentivize the prepayment and repayment of their equity first, right? So how it would work is $1 million is raised, investors would get that money back plus 10%. And then what's going to happen is they're going to participate in the future distributions of the business, because otherwise, taking all this risk for 10%, no one would do it, right? So the mechanism that's used is called a step up, and what that's doing is basically amplifying um, the percentage of ownership that they have in the business, accounting for how much leverage is taken on, right? Say it's it's $5 million business, you raise $1 million. What that would mean is it would usually convert into 2 million over $5 million would be the percentage that they would get, right? So 40% of all future distributions, and then the owner would be taking 60% after they return capital. So that's usually kind of structurally how it's set up. The outcome that a lot of investors are looking for the risk that they're taking on is probably around a 30% IRR. Most people are looking for a payback period on invested capital under 5 years. And if they account for an exit, maybe like a 3x multiple on their invested capital. Those are kind of like general thresholds, have been tossed around for quite a while. And that's structurally how it works. And then there's a lot of different components where we see, there's a lot of investors, they're like, I don't want to own a partial stake in this HVAC business forever. And owners like, I don't want to have investors forever. So then you'll kind of see these like call options where, after a certain return profile is hit, the operator is actually going to use the cash flow from the business to start buying out the position of investors. I actually thought that this would be like investors wouldn't be as excited about this, but it's actually like something that they're more keen on than anything. And that's like structurally how it works. If you have any like kind of follow-up questions, it's be a little bit complex. So hopefully that wasn't too.
Well, I mean, I know every deal is a little bit different, but thanks for sharing, kind of a general structure. So, well, boy, I mean, we covered an absolute ton today on, ways to buy smart, certain things that you can do. Um, Ben, what closing remarks do you have? I mean, as the lender in the group, I mean, you see more buyers than a lot of people. So what are some of your closing remarks?
I mean, look, I think if you're a buyer out in the market and you're thinking about buying a company, listen to our podcast, because there's a lot of tea leaves in there of information that you can take that maybe before you didn't have access to. And that is ultimately the goal, is the sharing of information here to be able to put people in a better position as they think about their go-to market strategy. So that's really what I would leave here today with, is if you're a buyer, a lot of good data points in here.
So you're saying like and subscribe.
Like and subscribe.
Like and subscribe.
Judd,
Love
are you
that.
going to be at IBBA in Orlando in May?
I don't know. Maybe.
Okay.
We'll see.
All right. I feel like somebody from Main Chairs will be there, right?
Yeah.
What about
Well, I hope to see you down there.
what about
Yeah,
the
that'd be
S&B bash?
I think there's someone on our team going. I'm just in the lab here in Austin, Texas. But there's
Just grinding away.
plenty
They don't let you out. Yeah.
Right.
of on our team are getting out in the market, so it's good for them.
Awesome.
Good.
Well, guys, thanks so much for taking the time today. For our listeners out there, next month we're going to be covering sell side, growing your business 2 to 5 years out. Why business valuation needs to make sense, right? What steps can you do to maximize this nugget? Kind of touched on it today. Valuations are based on the last 3 years. So why not start now if you want to sell 2 to 5 years down the road? We're going to cover all of those tips, tricks, and growth strategies for you. And can't wait to cover all of that. So like we said earlier, like and subscribe, give us a listen. Judd, thanks so much for sharing Main Shares today with everyone, and offering your insights to our listeners.
It was a pleasure. Thank you for having me. Y'all are great to work with. So anyone listening, this is the group.
I appreciate that, man. Thanks so much.
Thanks, Judd.
Yeah.